Hey guys, welcome to trading video. Okay, for a change I thought I'd come to the whiteboard. Now, I followed Wyckoff stuff, or I studied Wyckoff stuff for so many years. I love it. It's pure price action, it's pure tape reading, and it holds just as true today as it did all those years ago. So floating around on social media now is this kind of breakout and markup chart that Wyckoff talks about. What I want to do is run through it and explain how we can trade it and what it all means. So it's a breakout, accumulation and markup type scenario. Now, this time scale isn't going to be linear, but it's just an idea of how price moves in relation to other price points, to previous price points. So the first point you've got is accumulation. Now that basically just means that the price is sitting in a range. So it's just sitting here, kissing the highs, lows, and then all of a sudden it breaks to the downside. Now that does a couple of things. The first thing is it starts to drag in short sellers. They see that break, they think that it's going to break through, and they pile on. Same with longs. Longs who have been looking for a break out to the upside, and most likely the guys who are looking from the textbook scenario are going to put their stop there, and it's going to cause that break through that lower point of the range. So that little support level, your dotted line there that people will draw on their chart, a little breakthrough there, it's going to cause people to come in and you get that little spike lower. However, what that is now doing is that is creating excess of supply coming in, causing the spike lower. But if that just stops dead, that is giving you information. The information it's giving you is that there is demand pent up waiting for that opportunity. It comes in and demand comes in and spikes it straight back into that accumulation zone here and pushes it towards the high of the range. Now, why does it then break through the high of the range? Because it's got momentum behind it. And what I mean by momentum is not a case of price moving along at a quick pace. It basically means that you've got all the people who have started buying here, who are on the sidelines waiting for an opportunity, perceive that as value and bought that there. You've also got the people who were stopped out here looking to re-enter. You've got a lot of more participants coming in, causing this to blast through the highs. Normally this is going to be an increase in volume from around this point here all the way through to this point here will generally be an increase in volume because you've got more participants, you've excited a few more people, the shorts have got excited, they've now been stopped out, the longs have got in, so you start getting interesting. A breakout here, which is like the second phase of it. So because there's so much momentum through it, there's not really that much supply coming in at that high anymore because all the supplies are already come in, or if there is, there's so much demand that it's going to push it through. Now what happens? The textbook guys are thinking, you know what, it's broken out of the range, I'm going to start to buy it here. And of course, you know what happens, it comes back. Most of them have got their stop under that level because that's what it tells them to do. So they're buying this breakout here, this breakout comes up, they're thinking great, or they're buying at any point from here actually up to here, comes out, comes down, stops them all out, as well as sucking in a few shorts who think it's a fake out. But again, you've got the scenario where how has price responded to a key level? That's the key around the whole of the study. Here, price response was, it didn't bring any more sellers, it actually brought in demand. Same here, it didn't bring any sellers who thought it was a fake out, it was demand who stepped up and thought, actually, you know what, we've retraced quite a bit, now I'm going to get interested. Of course, now this is the big part of the move. This is when you get the real meat. And actually, as I said before, this is not going to be linear at all. You know, this is going to be much more compressed time-wise from here to here than this, generally speaking. And that's all we can do as traders anyways, look at it generally. So we get that blast to the upside, really strong move, the strongest for a while, takes out that high with not much messing around. Anyone who's thinking of shorting that is just getting stopped out straight away. And then we come up and we get a really tight bull flag position, or scenario should I say. Drive up, and this is like phase one generally. You know, if you forget about all this, this is a kind of setup on its own from here to here. But this is kind of phase one of a volatility expansion, I call it. So you get the drive up, volume will spike, you get a little bit of momentum in it, you get the bull flag here, and this is almost like a mini version of this. And often you'll get, you know, if you draw the low in here, it's going to break out underneath, test a few shorts, suck a few shorts in. That then says that's the end of the supply. Supply's coming in, no more supply. What is there to do? Seesaw, demand comes in, bang, up we go for another leg. There's the second leg higher. Then you get your like deeper second pullback correction, and then you get a further move on. And what's missed out on this is generally speaking then number three. So if that's number one, you know, that's number two from a volatility expansion position if we're starting from zero here. 1, 2, 3 generally tends to be a much more of a measured kind of move, and then a push on if indeed it is a new trend. So trade ideas from that. Number one is looking for the people who are getting stopped out. Instead of being the person who's getting stopped out, looking to fade that move. So when you see it breaking out of a low here, look to fade it. Always manage your risk by putting in a stop under here. But if it starts to come back up, then there's no reason really, if you're quantifying risk, and it's the same with any trade, as long as you've got the risk quantified and it's measured, there's no reason not to take it. You've got to stop here, you're taking that, and you're looking for that volatility expansion, looking for the fact that you want to be early on. Yes, you're going to get stopped out plenty of times when it just comes, retest the level and goes again. However, the risk reward here, you've got your risk and then your reward is so much larger, generally makes it quite a good strategy over time. Similarly for this position, and similarly up here, if you don't want to get involved in all that at all, but you're just looking to get involved after you've seen the volatility expansion, yes, you're late to the party, and yes, there's not much juice in it, and yes, expect phase 2 and phase 3 to counter trends, so expect that to almost retest your entry if you're holding. If we're looking, this is the day, midway through the day, to retest your level, so you've got to be a little bit more nimble with your exit. However, you can get a little bit of a more focused long, looking for that tight flag. One of my kind of favourite setups after volatility expansion, tight bull flags, or they work really nicely vice versa in a bear flag scenario. Looking for that little dip under the flag point that fails. Normally you get a candle, maybe a candle with a bit of tail, a bit of volume that pushes straight back up. Quick long entry here, stop under here, looking for a further explosion up, and scaling out generally into that explosion. From a day trader's perspective, obviously it depends on the time frame of this. So that's my take on Wyckoff. Great stuff, worth studying. If you haven't looked at it, really recommend it.